Hey everyone, good morning and welcome back to the channel. As of now, we have discussed question number 1 to 10 of DCF series, DCF basic series, discounted cash flows. We will be starting question number 11 onwards. So let's get started. So question number 11 is, let's say that you use leverage free cash flow rather than unlevered free cash flows in your DCF. What is the effects? The question is asking using levered cash flow instead of unlevered cash flow in your DCF. Uh, Today, I have actually made a roadmap for all those questions where we actually are going to this approach we are going to follow. So where we will ask ourselves, so what does the question mean? So the question was about the usage of leverage cash flows rather than unlevered cash flow in the DCF and what would be the effects. So we are aware that if we use so the previously we have discussed this thing. So levered cash flow and unlevered cash flow and levered cash flow. In the previous episode we discussed about it. So unlevered cash flow is actually for both debt and equity holders, and levered cash flow is actually only for equity holders. So if we are using levered cash flow instead of unlevered cash flow, so this means that we will be only calculating the portion that is on, we will be calculating the portion that is only for the equity holders. And if you remember, we called it equity value. And if we use unlevered free cash flow, so we will calculate the portion which will be for both debt and equity holders. So that's enterprise value. So the questions which we need to ask ourselves are the tips. These are tips to follow. So what unlevered free cash flow means? So it represents the portion that is available to both equity holders and debt holders. So all enterprise value. If we are calculating unlevered free cash flow, so it will calculate the cash flows before taking into account interest payment, debt, principal repayments, and in other words, it's the cash flow available to all providers of capital. So both equity and debt holders are there. Equity, equity, and debt holders both are um, so all the cash flow available to both equity and debt holders, which are all the investors. Think about this. And if and when you use discount, if when you use discount, if you discount unlevered free cash flows at a weighted average cost of capital, so what will happen? So if when we discount unlevered free cash flows, the weighted average cost of capital, we will be using the cost of equity plus cost of debt. And when we discount using unlevered, when we actually discount unlevered free cash flow at weighted average cost of effect, weighted average cost of capital, this reflects, this actually blends in the debt and equity holders return, and we get an enterprise value. So enterprise value, and what does enterprise value means? Enterprise value means that the cash flow is available to both equity and debt holders, to the whole firm. So that's why free cash flow to firm is calculated. And enterprise value represents total value of the firm's core operations and independent of its capital structure. And to get equity value, we then adjust for non-operating items to get equity value, we adjust them for the non-operating items. So understand this thing. If we are if we are using levered free cash flows, so this will only represent the portion of equity value of the business. And if we are using, so in equity, the if we are only calculating the levered free cash flow, then we will not be using weighted average cost of capital, because that will give us the wrong this will not give us the true picture, and that will be wrong. So when we are calculating the levered free cash flow, and that will represent only that will only represent the equity holder share, and we will be using cost of equity only, because debt will not be there. If you remember, uh, if levered free cash flow is the cash flow after interest expense and after any mandatory debt repayments, and this means that debt investors have already been paid. So if the debt investors have been already paid, then taking the cost of debt into consideration doesn't make any sense, and whatsoever is remained, that belongs to the equity holders. So when you use levered free cash flow in DCF, you are directly valuing the equity portion of the business, and the discount levered and you discount levered free cash flow using the cost of equity only, not the weighted average cost of capital. Since only equity holders are receiving those cash flows, and the resulting value from the DCF is equity value, not enterprise value. And here the key takeaways will be that using unlevered free cash flow, we will discount it using weighted average cost of capital. If we are calculating unlevered free cash flow, we will be using weighted average cost of capital, and we will that will help us to calculate the enterprise value. But on the other hand, if we are calculating, or if we are using our levered free cash flow in the and we if we are calculating levered free cash flow, and we are forecasting that, so we will only be using cost of equity because the debt holders have been already paid. That's why that doesn't make sense to we use weighted average cost of capital to discount levered free cash flow. Just remember this thing. Um, so, and since we have discussed all these points, let's get back to the presentation. And using the wrong type of cash flow or discount rate actually will lead to inconsistent valuation. Uh, for instance, if you use levered free cash flow but still discount them using weighted average cost of capital, so you will be mixing equity only cash flows with a blended cost of capital, which would understate the company's true equity value. And in practice, analysts typically prefer unlevered free cash flow, not levered free cash flow, but unlevered free cash flow, and they prefer enterprise value because it's easier to compare across companies with different capital structures and levels of leverage. Levered free cash flow is more appropriate um, when you are when you specifically want to calculate the equity value only, which is highly leveraged transactions, or when in cases of highly leveraged transactions, or when valuing financial institutions. So in that case, leverage free cash flows will make more sense. So cash flow institution when valuing financial institutions, we discussed about these banks and insurance companies. So levered free cash flow will make more sense because in their capital structure, debt is actually debt. The conventional way, or the conventional meaning of debt doesn't follows here. So then only in those cases we calculate levered free cash flow. I hope this made sense. Let's move to question number 12 now. So question number 12 is about, if you use levered free cash flow, what would you use as a discount rate? And we have discussed this thing. just in the previous question. So the thing which we need to focus here is just ask yourself these questions. So what levered free cash flow actually represents? So levered free cash flow is cash flow available to equity shareholders. We have discussed this after accounting for all operating expenses, taxes, capital expenditures, changes in working capital, and importantly, interest payments on debt. And since debt obligations have been already subtracted, so levered cash flow represents the residual cash that equity investors could claim. And why weighted average cost of capital is not appropriate when we are discounting levered free cash flow. Uh, See, weighted average cost of capital is used when discounting unlevered free cash flow, because unlevered free cash flow is the cash flow available to all uh, capital providers, both debt and equity holders. And weighted average cost of capital blends the cost of equity and after tax cost of debt to reflect that the total risk to all investors. And however, since levered free cash flow is after debt, it is already leveraged. And using weighted average cost of capital would effectively double count the impact of debt. So, weighted average cost of debt includes cost of equity as well as cost of debt. And here in levered free cash flow, we have already taken care of the debt portion by subtracting interest expenses. So we will not be using weighted average cost of capital when we are discounting levered free cash flow. We will be only using cost of equity. And one more question that arises is using cost of equity, what happens? Because levered free cash flow reflects only the cash flow available to equity holders. The proper discount rate is the cost of equity, and the cost of equity captures the returns that investors require for the risk uh, they are they are taking by holding the company's stocks. And discounted levered free cash flow at the cost of equity directly yields the equity value of the company, and which is consistent with the perspective of equity holders. So that makes more sense to use only cost of equity when you are discounting levered free cash flow. And remember this, levered free cash flow is also known as FCFE, free cash flow to firm. And unlevered free cash flow is known as FCFF, free cash flow to firm. And this the unlevered is the free cash flow to the firm, and levered one is known as the free cash flow to equity only. So as the name suggests, it's equity, free cash flow to equity holders only. So we will only be using cost of equity to discount levered free cash flow. Let's move to okay. So the key takeaways, if you think about it, so levered free cash flow, we discount it with the cost of equity. So we will get the equity value. Unlevered free cash flow, we will discount it with the weighted average cost of capital and we will get the enterprise value. I hope this was clear. Let's move to question number 13 now. Question number 13 is about the calculation of terminal value. So when we discussed about the DCF template, how does the DCF looks like? We discussed about uh, the terminal value that represents the present value of all future cash flows a company is expected to generate beyond the explicit forecast period in a DCF model. And since forecasting cash flows indefinitely is impractical, so we estimate a terminal value to capture the value beyond the projected periods, which often constitute a large portion of company's total valuation. And there are two primary approaches. One is terminal value approach, and another one is uh, multiple multiple method approach. So multiples method approach Here, I have drawn down a roadmap for this to understand better. So multiple methods approach actually uses exit multiple approach. This means that here in this approach, we assume the company will be sold at the end of the projection period at a market-based multiple of the financial metrics such as EBITDA, EBIT, or free cash flow, and we can obtain that data from the peer companies analysis. And the key point here is to understand the exit multiple is derived by comparable company analysis or precedent transaction analysis. And this method is market driven and reflects what the buyers are willing to pay. There are pros to this approach that it's intuitive in nature and aligned with market realities. But the cons of using the drawdowns of using this uh, approach is that it's sensitive to the chosen multiple and less tied to the intrinsic growth assumptions. So intrinsic growth assumptions mean how for at what rate the company is going to grow in future. And the second approach is the Gordon growth method. So Gordon growth method we have discussed in detail. So this approach actually assumes that the companies will continue to generate cash flows indefinitely, growing at a stable and constant rate. That's why we use this formula. So there is a perpetual growth rate, the rate at which the company will keep on growing indefinitely, and the weighted average cost of capital uh, is the required rate of return. The key point here in this type of approach is that this is intrinsic value focused and reflecting this reflects the company's ability to generate cash in the long term. Uh, Pros, if you talk about the benefits or the upsides, is that it's theoretically grounded and useful for mature companies with stable growth. So I if it's a company like Tesla or if it's a company like Apple. So we cannot assume that after at the end we can exit those companies because these are very large corporations uh, valued in trillions of dollars. So and if a company is mature and stable, so we can assume or we can use Gordon growth method approach to calculate the terminal value. Okay, terminal value. That's what we are discussing here. So the downsides are that this approach is actually very sensitive to the choice of growth rate and discount rate, and small changes can drastically affect the terminal value. So let's talk about examples for a moment. If in year five EBITDA is 100 million and comparable companies trade at an 8x EBITDA, so the terminal value would be 100 into 8, so 800 million USD. Yesterday we discussed this thing. Where is my Excel? Let me just show you. Okay, no, my Word file. If we are using comparable company approach, so this is the 8x multiple EBITDA, which we um, assumed using the comparable companies approach. And this is our terminal value. This is our this is our the last forecasted period unlevered free cash flow. So we can assume that the terminal value would be 8x, or it will somewhat give us around 32, 320 or 320, 320, 25 hundred thousands. That could have been our terminal value. And using uh, Gordon growth approach, this is pretty much it. So if we are using a Gordon growth model, we will calculate it based on the growth rate. So we will calculate It's on the basis of the perpetual growth rate, discount rate, and we will then calculate the enterprise value. So the the Gordon growth model is also for perpetual growth. The Gordon growth model is actually for perpetual growth or calculation of terminal value, and the EBITDA multiple approach is also for the calculation of terminal growth. Terminal growth. So this number we can either forecast by using Gordon growth formula, this number 467009, or we can forecast this number using the last forecasted number, and we can multiply it with the exit multiple. But uh, forecasting using Gordon growth model will be more sensible if we are using for a stable company, and uh, and if you want to be a little more intuitive or aligned with the market realities, so you will use a EBITDA multiple methods, which is a exit multiple approach. It says that we exit here. It means that we sell out our share of the stocks. So that doesn't mean that the company exits out of business. This means we exit here. So I hope this was clear, and I think we have covered it in detail now. So this is the formula: free cash flow into 1 plus growth rate. The growth rate is the perpetual growth rate, and we divide it by the R minus G, which is the required rate of return, and we subtract the growth rate. So we see uh, perpetually how what would be the group terminal value if the company stays in business. And here in terminal value, if we are using multiple method, we are assuming that what would be the the exit multiple, the last forecasted number, and we will multiply it with the 5-year EBITDA on the basis of we will get this number from the market. A practical little practical, and this is based on the intrinsic value. So I hope this made sense. And analysts actually often calculate terminal value using both of these methods to ensure consistency, uh, and discount back to present value. So terminal value must be discounted to present value using the company's weighted average cost of capital before adding it to the sum of the forecasted cash flows. And sensitivity analysis also is done because terminal value often accounts for 50 to 70% of the uh, total DCF value, and small changes in assumptions like multiples and growth rates or weighted average cost of capital can have a significant impact. So if you see here, the terminal value is somewhat around 50 to 70% of total DCF value. So if we add up these numbers and if we compare it with this number, so it will be more than 50 to 70% of the total DCF. And in short, if terminal value is the if we think about the terminal value is the bridge between the explicit forecast period and the company's long-term value. So choosing the right method and carefully justifying the assumptions is critical for a reliable DCF valuation. And we discussed that you actually have to defend your valuation also previously in the uh, enterprise value and all enterprise value and equity value questions. Whatever whatever valuation you do, you actually have to defend it if people ask you questions around that. So you should have all the answers to those also. And everyone has a different perspective about valuation. It's totally based on the information they have. And mm, uh, if I were to do a valuation of this stock, I would have taken. I would have the answer would have been different for me and relative to your answer. So that's all right. So that's the beauty of discounted cash flow or valuations, that uh, understanding everyone else's perspective is also important. Okay, so let's move to question number 14 now. I hope question number 11, 12, and 13 are clear. Next. So question number 13 is about Would you use Gordon growth rather than multiple method to calculate the terminal value? And we just discussed about it. So the basic of the terminal value is terminal value accounts for the majority of companies' valuation in the DCF, and because it represents all the future cash flows beyond the explicit period. Um, so there are two common approaches which we talked about. So one was multiple method, another one was Gordon growth method. So terminal value here, it's a metric into we multiply the market metric and we multiply with the exit multiple, and based on how similar companies are currently valued in the market. And this one is practical and more market oriented and widely used in investment banking. If we talk about Gordon growth, so Gordon growth, the terminal value is the final year's cash flow, and we multiplied uh, the Gordon growth formula, which is free cash flow at nth peak time and to 1 plus growth upon 1 minus r or 1 minus g, r minus g. So that's how we calculate the Gordon growth, uh, the terminal value using Gordon growth method. And Gordon growth actually assumes that cash flows grow at a constant rate forever. That's why there is a perpetual growth rate. Perpetuity means it will continue forever. And the growth rate is often tied to the long-term economic growths like GDP or inflation. So if the country is going to grow at a constant rate of three, or inflation is going to grow at a rate of 3%, so we will assume perpetual growth rate to be 3% for that country and that economy. Why the multiple method is usually preferred, if you think about it, because it's market driven, the data is available, and it's common in banking. So exit multiples are driven from comparable companies, and this aligns your DCF with what investors would realistically pay to you. So the availability of data is also there. It's easier to find market multiples than to estimate a precise long-term growth rate decades into future. And it's common in banking because analysts can justify their assumptions to the clients and auditors because they are backed by observable market data. And when does Gordon growth makes more sense than multiple method? While multiples dominate in practices, the Gordon growth can be better in specific situations where there is no reliable comparison. So if company operates in a unique market or niche where similar companies do not exist, so exit multiple may be meaningless. If those two companies do not operate in same markets or same niche, then multiple method will be meaningless. So if there are any second point would be if there are any structural changes in the industry are being expected. So if industry is highly cyclical or fast growing or expected to consolidate, the current market multiples might not reflect the long term reality. And for example, for a tech startup, current high multiples may drop significantly when the industry matures. Once the industry matures, and using a stable growth rate may not be appropriate for a tech company. And so, since we are talking about it, think about it from the perspective of a long-term cash flow perspective. So, Gordon growth is actually grounded in the fundamentals, and it relies on the sustainable growth rate rather than market sentiment. So, it's particularly useful for companies expected to generate stable cash flows indefinitely. And practical considerations. So, all this raises a question that what are the practical considerations for this? So the practical considerations is that estimating a growth rate is actually tricky. Picking a long-term growth rate is too high, can massively inflate the terminal value. And analysts usually anchor growth rate to long-term GDP of the GDP and the inflation of that country, or the industry growth rates, which are typically 2 to 5%. Why 4%? Why 3%? Because in perpetuity, if we are looking at if it's a long time horizon, so industry growth rate or economy's growth rate, they actually typically ranges in between to 2 to 5%. And there is historical data to back this up. And discount rate matter because sensitivity of terminal value to the discount rate is high. If we do a sensitivity analysis, so terminal value to discount rate, the sensitivity is very high, and small changes can dramatically affect valuation. So, this means that multiple method approach is best when you have good comparable data and want to market align valuation. And you need to justify assumptions in a banking context. And Gordon growth model is useful when when we are comparing data companies which are unreliable. Useful when comparables are unreliable. So if your comparisons are unreliable, then you will use a Gordon growth method. And the industry is cyclical or evolving, or you want a long-term fundamentals driven estimates, then you will use Gordon growth method. And in practice, most investment bankers default to multiples because sophisticated analysts may cross-check with the Gordon growth method to ensure the valuation makes sense under a steady state and long-term growth assumptions. So Gordon, in short, you will prefer Gordon growth approach when you want a fundamental cash flow based view of perpetuity value, and multiple method when you want a market based view grounded in current valuations. I hope this was clear. Let's move to question number 15 now. So question number 15 is, so what is the appropriate growth rate to use when we are calculating a terminal value? And we just discussed about it. So the appropriate growth rate would be if the growth rate of the economy, the GDP inflation of that country. So the terminal growth rate reflects the long-term sustainable growth of the company, which can be achieved once it matures. It's not meant to capture short-term performance or expansion phase. Instead, it represents the stable, modest growth that aligns with the long-run perspectives of the economy. And in other words, this assumes the company has reached a point where it's positive and market share and margins have stabilized. And its growth is driven mainly on macroeconomic factors such as population growth, inflation, and GDP growth. So typically it ranges in developed markets, it actually ranges from 2 to 3% and reflecting a long-term nominal GDP. And uh, this means that roughly 1 to 2% of real growth plus inflation. And in emerging markets like India, Brazil, and Southeast Asia, so this percentage is a little high. So it's in between 3 to 5% or 4 to 5% due to higher population growth and inflation expectations. And could be zero or negative to reflect contraction or erosion of market shares. So this rate could be the growth rate could be zero also. And anything higher than 5 is usually seen as too aggressive for a DCF, and especially for companies operating in mature economies. So 5 growth rate of 5% is too much aggressive. And, and for also to in importance, the terminal rate must be consistent with economic environment and the company's maturity and the assumptions used elsewhere in the model. So that's why the growth rate should be in between 2 to 3% for developed markets and 3 to 5% for uh, developing economies. And this could be zero also. Just go through this, just read through this for a moment. Okay, let's move to question number 16 now. So question number 16 is about how do you select the appropriate exit multiple when calculating the terminal value? And this question again is around terminal value only. So understanding of terminal value and exit multiples we have discussed. So terminal value, yet once more discuss about it. So terminal value actually represents the total value of company beyond the projected period in a DCF model and capturing the bulk of the company long-term value. Let me just show you my screen now one more time. So basically, majority of the weight of the whole DCF is lies in the terminal value, and it's very important to forecast terminal value properly. And one common method to calculate terminal value is exit multiple. We multiply the multiple to the uh, projected final projected years for this final projected years numbers. So exit multiples actually reflect how market might value the company at the end of the projected period. And selecting the comparable companies is important when we are talking about the appropriate exit multiple. And selecting the comparable companies means that those companies should be in the same industry, same sector, similar in size, growth trajectory, and profitability, and similar in risk profiles also, like geography, leverage. Leverages means the portion of debt in their cost structure and business models. So once you have peer groups, you can gather relevant valuation multiples like enterprise value to EBITDA or enterprise value to EBIT or price to earnings from their current trading prices. And the second step where to calculate the terminal value using appropriate exit multiple is choosing the baseline multiples, medians and means. So medians will be preferred as it reduces the impact of extremely high or low multiples, and mean sometimes can be used but can distort out the outliers also. So when you are choosing um, multiple, so you need to also take into considerations the outliers also. So outliers are those numbers which do not fall in the range. We have not discussed about outliers, so we'll discuss about outliers in our next reading. So if we summarize this whole thing, so first we need to identify the peer set of comparable companies. Then we need to collect the relevant information, the relevant trading multiples, and focus on the median. And then we need to adjust for the company specific growth, risk, and profitability. After that, we present a range of multiples to illustrate sensitivity. Sensitivity analysis is very important. sensitivity to the valuation. And we they cross-check that the multiple which we are using is reasonable in the long-term context also. And this actually ensures your terminal value is both market informed and tailored to the company, while also transparently showing uncertainty consistent with market reality. So whenever we are using market comparable data, we need to always screen in between companies which would be of the same industry or sector, similar in size, growth, and trajectory, and profitability, and along with the risk profiles, geography and business models. What was new here was discussing about the mean and the medians. So mean, median, there might be those companies also which are uh, extremely doing well or is extremely doing bad. So we will actually have to exclude those companies from our uh, sample size to select the exit multiple, because they will actually distort uh, our mean or medians. In the case of mean, when we are discussing about mean, the average mean, so that would be more sensible to ignore the outliers, so that we can we can reach to a number which makes more and better sense. And then we adjust for company specific factors, growth prospects, profitability, risk profiles, and market positions. And then we use that exit multiple, which should be reasonable in long term context, and should show transparency for both market informed and tailored to the company also. Choosing an exit multiple, and that's how we select the exit multiple. All right, so let's move to question number 17. Which method of calculating terminal value will give you higher valuation? So terminal value represents the business beyond the forecasted period in a DCF. And since projecting future cash flows for in the future is difficult, terminal value often accounts for significant portion of total valuation. So the method used can materially impact the final number. The question is, which method will you choose and which method will give you a higher valuation? So we have discussed about multiple method and Gordon growth method previously also in the previous question. So it will heavily the which method will give you higher valuation will depend heavily on assumptions, and there is no absolute rule. And in practice, multiple method often produce a higher terminal value because market-based multiples can be optimistic, and especially if recent comparable companies are trading at high valuations. Gordon growth method tend to be more conservative because sustainable growth rates are usually lower than the high multiples implied by the market rate. So the key thing to pay attention to is that multiples actually amplify market sentiments, and they are volatile. And Gordon growth is more grounded in fundamentals and long-term expectations. So the best practice in valuation is to calculate both and understand the range. And using the multiples for market perspective, Gordon growth is a reality check. All right. I hope this was clear. Let's go to question number 18 now. Let's talk about question number 18. So question number 18 is, what's the flaw with basing terminal multiple on what public company comparables are traded at? So basing taking base of term multiples, basing terminal multiple on trading multiples of public comparables has several limitations and risks. Primary issue is that the public market valuations are highly time sensitive also. So multiples like enterprise value to EBITDA or price to earnings reflect investors' expectations about growth, profitability, interest rates, and risk at a specific point in time. So these factors are unlikely to remain constant over 5 to 10 years horizon, and especially used for projecting a company's cash flows. So, for example, if you use today's median earning, if you use today's median enterprise value to EBITDA multiple for a company in a cyclical industry such as semiconductor, you could significantly misestimate the terminal value. And cyclical industries experience periods of expansions and contraction, so which leads to substantial swing in the market multiples. A multiple that seems reasonable today could be much too high or too low at the end of the projected period, and depending on where the cycle is at that time. And another problem is that the public comparables may not perfectly represent the company you are valuing, and differences in growth prospects, margins, capital structure, and geographic exposure can make the multiples of public companies a poor proxy. And because of these uncertainties, analysts typically look at a range of exit multiples rather than relying on a single number. They also perform sensitivity analysis to show how the valuation change across different multiples and cross-check with other approaches such as perpetuity growth method, which links terminal value to long-term cash flow growth and discount rates, providing a more fundamental view of the business's intrinsic value. I hope this is making sense. And think about it. Using current public comparables for terminal multiples can be misleading because it assumes that the today's market conditions, investor sentiment, and industry cycles will remain stable. An assumption that rarely holds in practice. Just take into reference the COVID-19 pandemic. Uh, and a more robust approach incorporates ranges, sensitivity testing, and alternate methods to account for future uncertainty. And yes, this does make sense. Why exit multiples? Why performing an sensitivity analysis for different exit multiples is very important. So we do not rely on a single exit multiple. We take a range of exit multiples and we do a sensitivity analysis of terminal value with those multiples so that we can see how sensitive terminal value is to those multiples. And it's important to forecast terminal value uh, not correctly but sensibly. So there is nothing correct or right or wrong, but it should be sensible to forecast terminal value uh, with due diligence and at utmost attention, because it's 50 to 70% of the whole DCF, the numbers, if we compare the numbers, so it lies in the terminal value, and that number cannot be wrong. So we need to understand whether a multiple approach would be better or the Gordon growth method will be better. And for Gordon growth, you actually need to look into the economy, the GDP, and other factors also. Gordon growth is actually used for mature companies. And we have discussed all of these points in the previous questions also. I hope this was clear and this does make sense because all these questions in today's session we had uh, somehow we have been discussing about terminal value. So I hope as of now terminal value is clear. And in previous questions we have been talking about levered and unlevered free cash flow and mm, weighted average cost of capital. So let's go to question number 19. So question number 19 is, how do you know if DCF is too dependent on future assumptions? So before you answer this question, think about the DCF's structure view. So DCF, discounted cash flows, value a company by projecting the future cash flows. Let me just show you my another screen, this DCF. So I think that when we're discussing about DCF, it's more relevant to use this image every time we get a question, so that you all these concepts are crystal clear to you. So we actually forecast by we project the future cash flows. We first project the future cash flows and we then discount them back to the present value. This is the first thing what DCF means. And we forecast it for a period of 5 to 10 years, and then we estimate a terminal value. And terminal value we can estimate using two methods, two approaches. Perpetuity method. This is the formula for perpetuity method, where we are assuming that the company will keep on growing forever. And then there is the exit multiple method, which we have discussed in detail in the previous questions, where we multiply the EBITDA or any multiple, and we multiply it with, for example, 8x. We will assume that uh, this much is the terminal value after using the term exit multiple approach. So since we have forecasted all these numbers, we will calculate the enterprise value, which is the sum of all the present values of the Experities forecast cash flows and the terminal value. We will calculate the enterprise value. And why terminal value matters? Because in most of the cases, terminal value actually dominates the enterprise value calculation. The first reason is that the forecasting period is short relative to the company's expected life, and cash flow often grow modestly in a forecasted period, but are assumed to be continuously continue. They are assumed that they assume to continue indefinitely afterwards. And small change in the discount rate or terminal growth rate can have huge impact due to compounding effect over an indefinite period. For let's assume that if the perpetuity growth rate is 5% instead of 4%, 1% change in terminal growth rate can change this value by somewhat around 20 to 30%. So that's why they are sensitive to growth rates. The one problem here is that it's too much dependent on the future assumptions. So DCF is actually too much dependent on the future assumptions which are used here, and the assumptions which are used to forecast the terminal value. So assumptions in far in the future are inherently uncertain. So if I ask you to forecast the future, so 99% of the time you will not be sure, or 99% of the times you will be wrong, because forecasting future you cannot always be certain. So there is always uncertainty. You never know how tomorrow is going to be. So that's why these are inherently uncertain, and this means that you have little visibility into the company's future performance 10 years from now. Small errors get magnified in a DCF because terminal value compounds indefinitely, and minor mistakes in the growth rate and margins or discount rate creates a major swing in an enterprise value. So like we discussed, if this percentage was not 4%, or if this perpetual growth rate grows by 1%, this will impact our terminal value by 20 to 30%. Uh, so small errors get magnified, and investors credibility, if you think it from the point of view of investors credibility point of view, if most of your valuation rests on the distant assumptions, so in future assumptions, It would be hard to defend an interview or a boardroom or a due diligence board to understand this thing. And I mean, we have discussed that with majority of the portion, majority of the amounts in the majority of the weight lies with the discounted in the DCF lies with the terminal value. So I have created this terminal value, percentage of enterprise value and interpretation here. So if the terminal value is below 50%, so this is a rare case, but indicates a strong name term. It indicates that there is going to be a strong near-term cash flow contribution in the organization. 50 to 70% is common in DCFs and it's acceptable but should be reviewed. If terminal value is 70% to 80%, so terminal value actually dominates. So you actually need to check assumptions carefully. 50 to 70% is the green range. Okay, but let's keep a green. It, it's a green flag, but all these others are actually red flags. So if your terminal value weights 70 to 80% of your whole valuation, so you need to check the assumptions carefully. If it's more than 80 to 90%, there is higher risk and the model is likely to be sensitive to long-term assumptions. And if it's 90%, it's extreme and you need to rethink the forecasting period or terminal assumptions. The question which we were discussing was, how do you know that your DCF is too dependent on the future assumptions? And I believe that we have uh, captured all those points which could be that can impact our future assumptions. So if these kind of things happen, so what we can do is we can extend the forecast period. We can stress test our assumptions. We can revisit the terminal growth rates or multiples after doing the forecasting. We can cross-check with other valuations methods also, like precedent transactions, trading comps, some of the parts valuation to do a sanity check for the DCF. And we can clearly communicate our assumptions. So whenever, if you are in front of a panel, uh, these are theoretical questions, but in most of the cases, they are more interested in what assumptions you have taken and why you have taken those assumptions. So those assumptions, if your interviewing panel is asking you, why have you taken those assumptions? So in short, they are asking you just with the same single question, they are asking you everything about the whole model. So if they are asking you why you have taken those assumptions, you need to answer these questions in reference with the economy. So what's happening in the economy? Why you have taken, why do you think that in the long term growth rate is this much? And what are the political scenarios happening inside those countries? Uh, the government's perspective, even from the political angle, what sector and uh, what are the goals of the current government, and what does the current government is promoting? So everything will all these information you will use to forecast your growth rates or your assumptions, and this will be very sensitive uh, to your this will be because understand this thing, the growth rates, the terminal value, all these are dependent on some kind of rates assumptions. So your assumptions will be very much sensitive to what's happening in the economy, and that's what uh, they actually want. They want to know whether you are aware about these situations or not. So you can do one thing. You can start updating yourself. Start reading newspapers. Start reading articles. Industry reports are there, and whatsoever content you can do, you can get. Just uh, try to understand that content, because your learning never goes waste. Understand this thing. If you're investing some time into any kind of learning, it will not go waste. Maybe not immediately, but you will start thinking about those things from that perspective. And you can read for 10 hours, but unless until you digest these that in 10 hours information, uh, you need to digest at least for 4 hours to understand the process. You need to process that information. It's not about reading and understanding, but it's about processing. Are you even able to process that information and apply it somewhere else? So that's the whole crux of this. Uh, so let's not digress from the questions, because it will just increase our time only. So, the key takeaways, if you think about it, that DCF naturally rely heavily on the terminal value, and it's not inherently wrong. The key is awareness and transparency here. And be able to explain why terminal value is high, and show that you have stress tested assumptions, and ensure that your forecasted cash flows are realistic as possible. And if, in short, if DCF is too dependent on future assumptions, it's uncommon. So DCF is too dependent on future assumptions. But when terminal value dominates more than 80 to 90% of enterprise value, it's a red flag to revisit. You need to visit your assumptions and model structure. Just understand this thing. Terminal value should be in between 60 to 70%. It's the green range. Above that, because the DCF is too dependent on the assumptions, whether it's the multiple approach or you are using the golden growth approach. So in both either ways, you need to actually uh, take into consideration your assumptions. So that. This is actually a very good question, and it's been. If I'm using about the future assumptions, and if you are you are not able to justify your assumptions, and you are incorrectly using those assumptions, so your valuation will never be in sync with what the market is going on, with not with the market. So let's move to question number 20, the last question of this reading today. Uh, so question number 20 is, should cost of equity be higher for a $5, 5 billion or 500 million market cap company? So when you're comparing a $5 billion company to a $500 million company, so the cost of equity is generally higher for smaller companies. And why so? So there are several reasons for that. So small size means, so size related risk is there. So smaller companies tend to have inherently riskier. So smaller companies tend to be inherently riskier than large companies, and they have less diversified revenue streams. This means that a single product or client can request a large portion of revenue. So if your revenue is coming in from a single client, so it is actually a less diversified stream of revenue. So low, and also lower access to the capital markets, and that's what makes it hard to raise funds using downturns. Greater vulnerability to greater vulnerability to economic cycles and competitive pressure also. So small companies actually have a greater vulnerability and to economic cycles and competitive pressure. And because these factors, investors perceive small cap companies as riskier, uh, and therefore demand a higher expected return for to compensate for the risk. And this actually is the reason for high cost of equity with smaller companies. So there is a market-based evidence that which there has been empirical studies which such as those based on the pharma French three factor model. That shows the smaller companies historically outperform large ones over the long term, but higher volatility is always there. And this small firm's premium is essentially a reward for taking on additional risk. Practical implications for this is that if two companies operate in the same industry with similar operating metrics, the smaller company's cost of equity will generally be higher because investors perceive it as riskier. And this higher required return is reflected in discounted cash flow valuation and hurdle rates and investment decisions. And all else being equal, a 500 million company should have a higher cost of equity than a 5 billion company. $5 billion company due to its higher perceived risk, lower financial flexibility, and historical evidence of greater return volatility. And including a size premium in calculation formally captures this difference. So that's why smaller companies have higher cost of equity. So thank you for today. That will be all. And I believe that we have discussed all these points, all these things in detail. Uh, All right, then I will see you in the next video. Thank you. Thank you for your time.